Okay, give me a sentiment check here when it comes to market direction. You say now is not the time to be adding to equities because US stocks have been driven by FOMO, not fundamentals. Can you elaborate?
Exactly. Look, I think, we can't deny that the data has been decent, but it's still on a downward trend. If you look at PMIs in the US that are hovering around 50, in Europe and China that are sub 50, an unemployment rate in the US that is starting to tick up, and inflation that this week is probably going to slow down again. So we think these are ominous signs for the equity market, despite a rip-roaring year that it's had so far. So that's why we'd rather be shying away from adding more to equities at this point in the market cycle, and why we prefer bonds.
Okay, so let's talk about the strategy here. You're overweight investment grade bonds. You're also buyers of the sell-off in USTs. So what's your target rate on the 10-year, and what are you telling clients right now about exposure to this space?
I think the 10-year can end the year lower than what it is right now. I think the great thing about the 10-year US Treasury right now is that you're getting a decent income and potential price appreciation for the first time in a long time. You haven't had those two things in many, many years. So if you're locking in today, you've got it on your screen there, a yield of 429. And if data does start rolling over, as I suggested in your first question, then you're going to get price appreciation too of a couple of points. So that will give you an equity-like return of say 6%, 7% on the world's safe haven security, which is not bad. And we think it's going to give you less of a roller coaster ride than say a traditional stock would do.
Okay, so how long do you think this type of percentage return can stay, particularly on mid to longer dated treasuries? Because the question is, of course, what is the US Federal Reserve going to do? Can Chair Powell avoid a hard landing? And of course, the data points also coming up in the US have the potential to move these numbers around. So how sustainable are some of the returns that we're seeing?
I think that's a great point, and I think that's why you don't want to be in the short end of the curve, which is probably the most tempting, because 2-year treasuries are giving you 5%, but that yield is not going to be there in 2 years. Same for cash. Cash rates in Europe now are giving you 4+. In sterling and dollar, you're getting 5+, but that cash rate is not going to be there in a year. So we think actually a sweet spot for investors could be 5 years, because they don't have to take the duration risk of 10 years that we were just talking about, and they don't have the reinvestment risk of 2 years. There's a lot of 5-year investment grade bonds out there that are giving you 6% plus, household names in Europe, US, and the rest of the world. So clients can build a portfolio of bonds for the first time in a long time that gives them that equity-like return without having to stomach the volatility of the stock market. So we think, you have to go a bit further out the curve, not 2 year. You don't have to go as far as 10. 5 year could be the sweet spot for a lot of investors.